The ups and the downs of the stock market, which is called volatility. Volatility isn't much fun, right? When values are down, it really takes a toll on our emotions, and emotions lead people to do things like sell investments, move to a more conservative portfolio, or just shift over to cash. And doing these things could really ruin their long-term results as well as hurt their financial future. In today's episode, we're going to talk about the case for staying invested and strategies to implement in your portfolio versus letting emotions ruin your long-term results.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Your Life, Your Money podcast. I'm your host, Scott Searins, and in today's episode, we've got a really good article that I'm going to go over for you called The Case for Always Staying Invested. Tell you what, there's a lot going on right now, right? Whether it be geopolitical events, inflation, and just all of that causing market volatility. And sometimes that really plays on to our emotions, making us wonder, what should we do with our investments? And I thought this was a really good piece on why we need to stay invested. No, I'm not saying that you have to be 100% in equities, and you'll see that as we go through the article. But we're going to talk about the points in this article, but more importantly, stick around to the end, because what we're going to do that the article doesn't is we're going to talk about how you take this information and use it and take action based on the information here. Now, whether you're a long-time listener or this is your first time, I hope that you continue to find this podcast as well as others to be of value and benefit. I hope that you've learned something new. I hope that I'm making a positive impact on your life, and I hope that listening is helping you build confidence in your finances and your future. And if so, help others. Share this with somebody that you know. Share it with a friend. Share it with a coworker. Share it with a family member, somebody that you care about. Share it with a Facebook group that you think could find it helpful. I really thank you for listening and your support as I continue on this journey of helping you and others thrive in life, wealth, and retirement. All right, here we go. Back to the article. But before we dive in here, my compliance department would really like for me to remind you that, first off, past performance is not indicative of future results. When I talk about the S&P 500, that's an index that measures, the 500 largest U.S. stocks. You can't actually invest in the S&P 500. However, you can go and get different types of funds that replicate the S&P 500. And then last is investing involves risk. And that's actually exactly why we're talking about this article today, right? There's a lot going on in our economy right now. We've got inflation going up. We've got a lot of geopolitical events, the Fed raising interest rates, and all of these dynamics, right? These dynamics create market volatility. And we foresee that there might be some market volatility for the foreseeable future. First off, what is market volatility? Well, market volatility is the ups and the downs in the market. Now, I get it, right? It's human nature, just human nature, to focus on the downs, to remember the downs. But here's what I've asked you. If you're a long-term investor, and we'll talk about that in just a second here. If you're a long-term investor, are you really down? And I'm going to share a quick story with you here, right? And this is why I get so frustrated that the custodians, wherever your investments are held, some of them send out quarterly statements, some of them send out monthly statements. I get so frustrated with these statements because they should actually send you a statement that says, hey, here's how much the value has changed since inception. And here's why I get frustrated with this. And not frustrated with you, it's just human nature, right? It's human nature that if we get a monthly statement, we're going to look at that statement and say, what is our value compared to wherever the beginning of that statement was? So quick story, and going through right now our strategy meetings with clients, and had a client come in and say, hey, our value is down for the month of January. We're we're kind of worried about this, what's going on in the market. And we talked through everything, but, and yeah, it's actually a but, and here's a big but. That was looking at one statement. And what I did is I framed it differently, right? We don't want to let short-term perspective ruin long-term results. And they weren't coming in looking to change their plan or make any changes. They just wanted to talk about that. And we framed it up differently because we looked at where they were from when they started investing, and they were actually up. So here's my question to you. When you look at your statement, are you really down? Are you really down? And you have to look at this from when you started investing, because you may actually be up. And so again, don't let short-term perspective ruin those long-term results. And I'll talk about that some more as we go through some of these points when I say don't let it ruin. And these folks weren't letting it ruin any sort of long-term results, but I also want to just put things in perspective. Are you really down? And then remember this too, is your value is down, right? Or let's just say you are down. It's your value that's down, and it's not a loss unless you actually sell. But from beginning, if you're up, well, then you're still at a gain. So that's one thing to keep into perspective, right? And how did I get into that? We're talking about volatility, the ups and the downs. Yes, we're going to focus on those downs because it's just human nature. But remember, are you pulling a short-term result, or are you looking at the overall picture of your investment horizon? Which brings me to the next point here. So in this article here, right, it says there was an AAII investor sentiment survey that showed that less than 20% of respondents feel bullish right now, the lowest reading in more than 5 years. So it's no wonder why we're hearing questions of whether it's time to get out of the market or hold on to excess cash until the storm passes. And then it says the short answer is it's not. In fact, for most investors that are long-term investors, and you might be sitting there thinking, well, am I a long-term investor? What's my time horizon? And I really want you to think about that differently too, right? If you're going to be investing for, let's just say, at least 5 years, you're a long-term investor. And wherever you might be at in life, right? If you're in your 80s, you're a long-term investor. If you're in your 70s, you're a long-term investor. If you're in your 60s, 50s, 40s, you're a long-term investor because you're going to be investing for more than 5 years. Now, it says, or should hold on to excess cash. Now, that's one thing that we've talked about. Go through some maybe past episodes, look for listener questions, look for episodes on this, is how much cash should you keep? Yes, you should have some cash on hand. I always talk about having, at least a 3-month cash reserve or a 6-month cash reserve. And what we've found too is just having a cash reserve that mentally makes you feel comfortable, but review that every year just to make sure that your cash reserve isn't too big. The other thing is put a lot of this into perspective. Go back a few episodes where I talk about bear markets, crashes, and the timing and duration of all of these types of things. And you'll see that, if you're going to, again, be investing for 5 years or more, you're a long-term investor. So what the article is saying, hey, if you're a long-term investor, then the short answer is you should stay invested. Okay, so that was just the summary, right? The kind of the intro summary to the article, but why should we stay invested? And let's get into some of the points here in the article that I really appreciated and want to maybe spell out to you in a different way than the article did, but use some of their points as well here. So the first reason of why you should stay invested is because it says diversification works. And I think it's important to understand what is diversification and what is not diversification. So what is diversification? And I'm going to use an analogy to kind of help you understand diversification when it comes to your investment portfolio. Let's just say that you are the owner of a fruit stand. Okay? Now, if you're the owner of a fruit stand, I'm sure you're already thinking, right? It's in your best interest not to just sell one fruit, right? Not just to focus on one fruit, not just to focus on oranges, right? It's going to be in your best interest to sell a variety of fruits, not just one. Now, hear me out here. Let's just say you focus on one fruit, right? You're going to focus on oranges. And let's just say that oranges becomes Oprah's next best thing, right? Or I don't follow Oprah, but I've always heard things really take off when she puts things on her list. And let's say she puts oranges on her list, right? So then oranges really takes off and your fruit stand is doing awesome, right? You're doing so great. Everything's going wonderful. But then let's just say this, you're getting your oranges from Florida and there's a hurricane that wipes out Florida and you no longer have the ability to get any oranges. And now your fruit stand has to shut down. It has to close because all you did was focus on oranges. So focusing on one thing, right? You have that ability to potentially outperform, but then you also have a very big ability to underperform. And so that's why I said, hey, it's in your best interest to sell a variety of fruits, right? So maybe you're going to sell oranges, apples that are coming from the Northeast, right? And then you're going to sell bananas that are coming from Hawaii. That's now diversification, right? You're going from selling one fruit to selling multiple fruits. Okay, so, and then back to our hurricane, right? The hurricane wipes out the oranges. Well, you now still have the ability, right, through diversification to sell apples, to sell bananas, and to continue to keep that business going. Let's just take this a step further, right? We all have different taste. So maybe when it comes to your apples, you're also deciding to sell different types of apples. You've got the Granny Smith apples, the Golden Delicious apples, the Red Delicious apples. Hopefully you can kind of see where I'm going here. Putting everything into one fruit, yes, you might have some great outperformance of where the neighboring fruit stand is that, tried to sell multiple fruits. However, that neighboring fruit stand, right, isn't running into the issues because they're selling multiple fruits when there's a hurricane in Florida. And your oranges, you're no longer able to sell anything and you go out of business. So hopefully that helps you kind of think about diversification. So now let's talk about what that actually means for you and your portfolio. Okay, first off, what is diversification? Or let's actually start here. What is not diversification? What is not diversification? It is not diversification by having multiple funds with multiple advisors, right? Or having multiple advisors, multiple brokers, multiple accounts all over the place does not actually mean that you're diversified. Why is that? Well, what if all of those different accounts all over the place, right? So maybe you've got different custodians, different brokers, different advisors. What if they're all holding Microsoft, or they're all holding Apple, or they're all holding Tesla, right? That's just like all holding oranges in our example earlier. So having multiple brokers and advisors does not make you diversified. You might say, well, but they're all using mutual funds. Well, what if they're all putting you in a technology-based mutual fund? Then you're all still focused on technology-based stocks. So that's not diversification. Owning one stock, well, that's just like owning oranges, right? That's not diversification. Having more than 10% in one stock, that's where I say, hey, you really got to start to diversify more. So if you have more than 10% in a specific company's stock, you really want to start to diversify that stock, because what if something happened to your company? Just like the person selling oranges can become very emotionally attached to those oranges because everything was doing so well because they got put on Oprah's list. Those same emotions happen with your own company, right? Oh, everything's doing so well. This company's great. It'll never fail until it actually happens. So if you have more than 10% in one company stock, I really recommend you want to start diversifying yourself. And then what else is not diversification is just having a plethora, right? Like if you've got like 50, 60 mutual funds in one account, that's not diversification either. It just tells me that there's no strategy there. So what is diversification when it comes to investments? First is understanding your asset allocation. I told you earlier, it doesn't mean that you always have to be staying invested. Doesn't mean you have to be 100% in equities. First, you want to come up with your asset allocation. You've heard me talk a lot on the show about growth, the growth side of your bucket and the war chest side of your bucket. Well, that's saying, hey, what's going to go in the equity or stock side of your bucket, and then what's going to go in the bond war fund. The war chest is the bond funds or cash. What's going to go into that side of your bucket? So the high level of diversification, right? You're going to start with, hey, what do I put in stocks and bonds? Growth, war chest, equities, bond funds, okay? And then let's just use stocks. I'm going to use stocks to continue to break this down further for you. So, okay, hey, we're going to put money on the stock, equities, growth side, right? Well, then how much goes into large cap companies, mid cap companies, small cap companies, international companies, emerging market companies? And then in large cap companies, how much are we going to put in large cap growth companies, large cap value companies? Or maybe you want to instead break it down by sectors. How much is going to go in the technology sector, in the energy sector, in the financial sector? So hopefully that helps you understand what diversification looks like, what it means. Now, and here's what the article says, to be clear, a diverse portfolio won't keep up with one comprising of all equities when the stock market is rising. And this is something that I want you to really understand as well. And what does this mean? So each and every day you kind of see the different stock indexes, right? If you want to open up the newspaper or the app on your phone, and you kind of hear, oh, the Dow did this or the S&P did this. And you may hear that the S&P 500 is up 10%. Right? Let's just say for a month you look and you see, oh, I heard the S&P 500 was up 10%, but you look at your portfolio and you're only up 7%. Why is that? Well, the reason why that is because of diversification, right? The S&P 500 is large cap funds just in the U.S. And if you've got a diversified portfolio, you might have some, in the S&P, well, not actually in the S&P 500, right, an index that replicates it, but you might have some in large cap, but you also have some in mid cap, some in small cap. You might have some bond funds. You might have some international. You might have some emerging markets. So that's why your portfolio will do something different than what you're most likely, right, than what you're seeing in the news every day. And this talked about, too, the importance of diversification, right? So in 2022 sell-off, we've seen both stocks and core bonds decline, but even just a basic diversified portfolio comprising of 60% MSCI world equities and 40% global aggregate bond index exposure has offered protection. It says at the worst point in January, global stocks were down 8%. The diversified portfolio that I just mentioned was down only 75% as much, meaning it was down 6%. So that's also why, when things do go bad, this is where diversification comes into play and comes to help you as well. When things do go bad, then diversification, right? You might see where the market's down 20%, but because you're diversified, you've picked an asset allocation and a strategy that you're going to stick with and stay invested. When the market's down 20%, you may only be down 10% or 15% or 5%. It all depends on you and your allocation. Okay, that was case in point number one. I realize that was a long point to cover, and we still have a couple points to go. So stay with me here. I think that hopefully you're getting a lot of value out of this, of why you want to stay invested in the market as volatility happens, those ups and downs happen, right? And this next case in point here is actually ties into that fact of what does volatility create? Volatility creates a lot of emotions for us, right? Volatility is not fun. And when it's not fun, right, that's when emotions get involved. And I want to help give you just some statistics here to think a little bit differently. So Dalbar, a financial research firm, this is from the article, and again, I'm going to link to everything, lifemoneyshow.com. lifemoneyshow.com. You can find the link to the article here. Dalbar, a financial services research firm, has made sense of how emotions impact investor decisions by studying the timing of mutual fund flows. Based on that fund flow analysis, Dalbar approximates the return achieved by the average investor over a 20-year period, and its conclusion was that most investors are bad at market timing but still try to do it anyways. So here's the thing, right? We can stay invested or we can try to be a market timer. And there's a great chart in here, right, that I really want you to go and take a look at. And it shows the 20-year annualized return by asset class. We're looking at 2001 through 2020. Again, this was a Dalbar study. And it shows that if you were just invested in the S&P 500, your annualized return would have been 7.5% per year. A 60-40 portfolio, so that's 60% on the growth side, 40% in the war chest, 6.4% annualized return per year. The average investor, somebody who's letting emotions take over and think that they're going to time the market, right? The annualized return for the average investor, again, according to this study here, 2.9% per year. So just by holding on, let's just say you're in a 60-40 portfolio, just by staying invested, right? Not trying to time the market. Based on this study, it says that you would, is trying to time the market, you would have underperformed just staying in a basic 60-40 portfolio. You would have underperformed by 3.5% annualized. Let's just put that in dollar facts for you here, right? If you had $1 million or on your $1 million, 3.5% would be $35,000. So that's $35,000 in missed gains just by trying to time the market. Which leads to the next point in the article here that says timing the market is tough and missing the mark comes with consequences. Again, the case in point to stay invested versus trying to time the market, pull money out, put too much cash reserves to the side, right? Because when you try to, and going along with the article here, it doesn't talk about this, but one thing I want you to know is when you try to time the stock market, you have to make two right decisions. One, you have to make the right decision of when to get out, but then you also have to make the right decision of when to get back in. And if you've looked at history, right, 2008, 2020, 2022, right, the market does some really interesting things. Sometimes it shoots right back up like it did in 2020. Sometimes it comes up, then it goes back down, then it comes up, then it goes back down, and then it decides to come up. It's going to play with your emotions. So making that next decision of when to get back in is always a really tough decision to make. And it's an impossible decision to make and to get both of those right. And I thought this chart here that they've got in the article does a really good job of summarizing it. So it says the annual performance, annualized performance, right? And this says returns are based on the S&P 500 Total Return Index. Annualized performance from January 2002 to 2022. So again, 2002 to 2022. If a person would have stayed fully invested during that time frame, a 9.4% annualized performance. If you would have missed the 10 best days, you said, hey, I'm going to try to time the market. But again, it's an emotional roller coaster if you're going to try to go down that route. Miss the 10 best days, right? You're looking at a 5.2%, instead of 9.4%, now you're down to a 5.2% annualized performance. You missed the 20 best days of the market. You went from a 9.4% of staying fully invested down to a 2.51% annualized return. And if you miss the 30 best days, right, of being invested, fully invested was a 9.4% annualized return. Missed the 30 best days, you're now down to a 0.3% annualized return. Folks, again, I want you to think long term, right? And I realize that this chart covers 20 years, but you have to look at where you're at in life. And I'm guessing no matter where you're at in life, most of you have 20 years of an investment time horizon in front of you. So just like the article says here, timing the market is tough. It shows and proves out in the article here and in the stats and charts that they've given is staying fully invested is staying in your best interest. Again, from earlier, doesn't mean you have to be 100% in equities, and we'll talk about that. It just means staying fully invested into a strategy that's meant for you and your picture. Okay, the last case in point here, and then we're going to get into how do we take and use all this information and put it to work. All right, the last case in point here that they bring up is that there is always something to worry about, right? There's always something to worry about that's going to weigh on our emotions that says, should we still be in the market or should we get out? And I thought there's a whole list in here that just made me go, wow, we've been through a lot. We've been through a lot as a country. We've been through a lot as a world. We've been through a lot, and economies, right, and our people always prevail. But let me just give you even just some examples here since 2017. So the article talks about, it says, it's about remembering that the markets tend to right themselves as those risks pass. Since the start of 2017, an investment in the S&P 500 has more than doubled up to the present, despite all of the concerns that have plagued investors over the years. And so let's just talk about this, right? So since the start of 2017, an investment in the S&P 500 has more than doubled up to present time. And think about this. Since 2017, we had federal rate hikes. We had tensions in North Korea. 2018, we have trade wars going on. And then we had an inflation scare. 2019, more trade wars, an impeachment inquiry, global growth and shutdown. 2020, we had the presidential election. We had the COVID pandemic. 2021, Omicron variant, China regulatory crackdowns. Folks, that's a lot just in the last 5 years, and the market is still at a higher value today than it was at that point in time. And here's the thing. We're going to continue to see new things to be worried about. And I get it. It's easy to really look at those things and go, boy, I don't know. This time feels different. But just remember, the last time felt different. The time before that felt different. And here's the thing, and I know this maybe sounds a little bit fluffy, but there's one or two ways to go. You can go down that rabbit hole of everything's falling apart, or where I like to go. I think our people are strong. I think our culture is strong. I think our economy is strong. And I think that we and the companies in all of these economies will always prevail, and we'll find our way to that next thing, just like we found our way to help curb COVID, like we found our way to, help get through the 2008 financial crisis. We found our way to get through, name the thing that happens. We are constantly improving. We're constantly coming out with new technologies. We're constantly finding our way and prevailing through tough times. And so you can pick one side or the other, but I like to pick the side where we will continue to prevail. I think that we are smart human beings that will always find our way out of whatever issue is currently going on. So there we go. That was the last case in point there, is that there's always something to be worried about. And if we were to worry about all those things, you could try to time the market. I told you where timing's not going to work and how that could potentially, lower your overall annualized returns, or we just stay invested. Now, I get it, right? You're sitting there listening going, hey, Scott, this is great. And that's a lot of statistics that tell me that I should stay invested. But man, my emotions still really get involved. And so how do I take this conversation and how do I use it? How do I make sure that I stay invested? And how you do that is by having a strategy and a plan in place, right? Because I hear so many times, right, from not from our clients, but people calling in that would say, you know what, I pulled out my money in 2008, or they'll say, yeah, I've talked to somebody that they just said, hey, pull your money out. And I was really lucky, and I saved myself by pulling my money out. But what these folks are not telling you is, when did they go back in? And did they actually go back in at a higher price? And what has their annualized return been since inception, right? Since pulling that money out, since putting their money back in. So you're going to hear stories on that. The other story that I've heard, is, well, I'm getting close to retirement, so I just went ahead and switched to conservative because, boy, I don't know, I'm close to retirement. And I'll tell you what, that really tells me that there's no strategy in place. There's no blueprint in place. And that's what I want to take a few seconds here to talk to you about, is just what does it mean? How do we take this information? Yes, I heard the information loud and clear. And instead of doing these market timing games, instead of, just going and looking at what the 401k thing says and switching from aggressive to moderate to conservative, which those words really mean nothing to your overall plan, is what do we put into place here? And how do we do a strategy and a plan that you're going to stick to? And here's the thing, and I want to just relate this to building a home, right? When you're building a home, you just don't go out and buy a bunch of nails and a hammer and wood and start, right? That'd just like be going out and just buying a bunch of equities or bond funds and hoping it all works out. Instead, you sit down with the architect and you design what you want your home to look like. You take your thoughts and you put it on paper. And that's where we start too with our clients, is you need to design your retirement blueprint, your financial blueprint. When do you want to achieve financial independence? When do you want to retire? What do your expenses look like? How much are you going to need in the future for vacations, for gifting, for traveling, for making contributions, right? Getting all of that onto paper and creating your blueprint. And I like to call that a retirement income plan. Once you've got the retirement income plan in place, right, then the contractor, right? So we're the architect, we're the contractor, we're the project manager for our clients. Then you build the strategy, right? So you take that blueprint, then you go out and get the equipment, the tools, the products. You get what you need to actually build that specific house. The house that works for you, not for your neighbor, not for the guy down the street, the house that works for you. And as you develop that, right, so as you put together that blueprint, as you understand your future expenses and how much you're going to have for vacations and contributions and taxes and inflation, you're going to start to understand what kind of withdrawals that you're going to be needing to make from your accounts, right? Because Social Security wasn't meant to make up for all of your lifestyle needs. That's why you've saved your retirement savings. So you put together the blueprint, and it's going to tell you, hey, here's the withdrawals that you need to make from your accounts. Maybe you don't need to make withdrawals for 5 years. Well, then, based on that, maybe all of your money goes into the growth side of the bucket, right? Maybe let's just kind of use the example, you're within a year away from retirement or a couple years away from retirement, or you're retired. Well, then maybe based on your blueprint, you're going to need to start making withdrawals from your retirement savings. Now, no strategy in place, making these withdrawals, seeing the volatility in the market, most likely you're going to get caught up in emotions and want to go through and maybe not stay invested or sell your funds, right? Because that's tough. You're seeing values go up and go down. And when values go down, it gets scary because you're saying, hey, I need this money to live. And you might do some things that you're going to later regret. But by having a strategy, by having a plan, by understanding what kind of withdrawals that you might need to make in the next 5 years, well, let's take that money out of the volatility of the equity side of the market, right? So we're going to take that money that you know that you're going to need to make withdrawals from, and we're going to put it into a pool of funds that aren't subject to the same volatility of stocks and ETFs and mutual funds that are fully focused on equities. We're going to put that money in a pool of funds that now goes into your war chest. So that way, as you see this volatility, right, you say, hey, I've got my next 5 years. And I'm just using 5. Maybe it makes you feel more comfortable to have 6 years or 7 years worth of income needs in your war chest. Do what makes you feel comfortable. But having that balance is what I've found helps our clients stay invested as the growth side does its ups and downs. It does its volatility. But having that war chest there, having that pool of funds not subject to volatility, that you know that you've got a location to make your next 5, 6, 7, 8 years worth of withdrawals in the event as the market declines, while you can watch that market come back up. You're like, hey, I'm good. I've got my war chest here. That's what's going to help you stay invested. The other part is, and I'm going to say the last part here, which doesn't really go into home building, is just having a behavior coach. And that's kind of part of my role too, not only putting together the blueprint, not only being the contractor of the blueprint, right? Building the house, is then being the ongoing behavior coach, reminding clients of the blueprint, reminding them of the strategy, reminding them of the war chest, and reminding them why we stay invested. And that's another big part, is a lot of times we can let ourselves just get so emotionally involved that then you would make some of those wrong decisions. And so having that coach is really helpful as well. I hope that helps you understand kind of how to take this information, use it, and stay invested in a strategy that works best for you, works best for your blueprint, works best for your picture. And if you're feeling like you've got to jump out of the market, or that you need to try to time the market, it really tells me, or that you just should go and shift from, where you're at to conservative because you're getting close to retirement, it really tells me that you might not have a strategy in place. And so I'd highly recommend sit down with somebody, get a strategy in place. If you'd like to sit down and visit with us, lifemoneyshow.com. Again, lifemoneyshow.com, and it'll lead you to setting up a phone call with us here. So again, just hope though that today was providing you some value, benefit, and some confidence in regards to your future and your future with investments. Hey, if you found today to be of value and benefit, don't forget, subscribe on your favorite podcast player. And then also check us out at lifemoneyshow.com, where you can find additional videos, podcasts, blogs, all to help you build wealth and reduce your long-term tax picture. I look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.